Muted.
And we'll get to those questions at the end. So let's get into the presentation. So first and foremost, key takeaways. These are the key things that we hope you'll get out of the material. First, crude oil prices are depressed due to current global oversupply, and we are actually more supply long now than we were when prices initially collapsed. Crude oil oversupply, this will take between 1 to 3 years to correct, unless a major structural event takes out supply, like the strikes in Brazil or the situation on the ground in Venezuela and some of the civil unrest we're starting to see, or if OPEC, and really led by Saudi Arabia, decides to pull back a meaningful piece of supply. Those are the structural events that could change the story. But in absence of that, if we have to let the market sort it out, it's really 1 to 3 years. 1 to 3 years of relatively low prices will pull out enough production and allow demand to grow to a point which the market becomes balanced again and we see an equilibrium price going forward. U.S. crude production economics support significant growth at $70 TI. So Anadarko said it best. They said 70 is the new 90, and that's absolutely true. When we look at well efficiencies, we look at the size of wells, we look at how quickly they can be drilled, we look at some of the cost reductions that all the major producers have seen and some of the service companies have implemented. 70 really is the new 90 from a break-even perspective and how much crude we could grow at different prices. $100 barrel is no longer going to be the norm. So along those same lines, crude oil prices will be range-bound between $60 and $80 in the long term. And again, that all comes back to the economics of production and how much production is out there at different key price thresholds. In terms of quality, the 0 to 35 API barrel, that production's flat and steady. The question from here on out is how quickly that 35 plus API production can grow, and that again is all about economics. And then the export question. So another point, another important crude dynamic right now in the crude markets is the export question. Will the U.S. be able to export, and what would that mean? There's a couple things to think about. Before the U.S. production mark hits 12.5 to 13 million barrels, exports are important because of quality issues, because we're producing a lot of light crude, and light crude is taking over as a bigger percentage of U.S. production. That light crude is not a perfect fit in our U.S. refineries. So as we grow production, as we push out additional import barrels, those imported barrels are heavy. So there's going to be a price impact, and specifically a price impact for those light barrels. The ability to export really means we would send out our light barrels, we would keep bringing in heavy barrels, our refiners can make more of the high-value products, and our U.S. producers could get a better price for those light barrels because they are better suited in international refineries. After we hit 12.5 to 13 million barrels, exports are necessary. So we're going to look at refining capacity, but in a nutshell, there's about 12.5 to 13 million barrels a day of capacity that can be filled with U.S. domestic crude. Refining capacity in general is bigger than that, but we bring in imports. We have Canadian barrels coming down. We have imports that are structural, that come because PDVSA and Saudi Aramco and Petrobras, Pemex, they own parts of or whole U.S. refineries. So those barrels are sticky. They're harder to push out. So the actual capacity in our refining fleet to take U.S. crude is only about 12.5 to 13 million barrels. Once we produce past that, then it's U.S. producers competing with U.S. producers unless we can export. So exports are really necessary if we're going to grow past that mark. Now on the gas side, I don't have key takeaways for the gas side, but I think given what's happened with prices in the past month or so, the gas market, certainly prices are depressed today, but along the same lines as crude. We're not going to have 225 gas forever. So we're going to talk about what that looks like and how much structural demand will be out there later in the decade. And on the NGL side, we'll touch on NGLs briefly. So in order of presentation, we'll focus on crude first, then we'll talk about natural gas, then we'll talk about NGLs. NGLs, we have a view of ethane rejection. We have a view of how much excuse me, ethane will be rejected, or if we'll be short ethane once many of these world-scale crackers come online. We'll also show you our price forecast for NGLs and talk a little bit more about that. All right. Now, if you've just joined the presentation or you joined the presentation a few minutes late, We're going to jump right into the slides at this point, but if you have questions, if anything comes up along the way, please send those questions to info@ponderosa-advisors.com. Again, that's info@ponderosa-advisors.com. So let's jump right into crude. So global supply and demand, this is global supply and demand. This is IEA data. This is crude and other petroleum products. So this is the 93 million barrel a day market size you hear quoted in the news and in the media. This is just supply demand. So blue is supply, red is demand. If you look at those lines, you can see supply has tracked over demand really as far back as 2014. This is what signaled the price collapse. If you look at the right side of that chart and you look at the difference between supply and demand as recently as Q2 of this year, you can see we're actually more supply long now. Those lines are farther apart now than they were when prices first collapsed. So what does that mean? It means that, well, if you look at the trajectory of the demand line, demand is pretty flat. It has grown year over year, but it hasn't grown as much as it should have, given that crude prices have been basically 50% of what they were. What we know, Econ 101, if prices collapse or prices fall, you should see a response on the demand side. And the level of demand that we're currently seeing is saying that overall there is macroeconomic weakness. That demand number is not as high as it should be given how low crude prices are. If you look on the supply side, that blue line, that trajectory has actually increased over the past couple quarters. So what that means is we are continuing to see record numbers come out of Russia and all the major OPEC countries, where we continue to be relatively flat in the U.S., posting some growth in U.S. production volumes over last year. But overall, U.S. production's been pretty resilient. A lot of other countries have actually grown. So we are more supply long now than we were when this first started. If you look at what that means in terms of crude stocks, so this is globally. So this is crude stock changes. If it's above the axis, it means we're adding to global crude storage. If it's below the axis, it means we're pulling out. What you can see here is the same kind of thing we just mentioned. So we're still supply long. Since 2014, we've actually never net drawn from storage. This is another thing to keep in mind here is this is crude and other petroleum products. So this is the whole picture. So some of the things you might see weekly, even in the U.S. storage number, you might see crude additions, but product storage coming down. When you look at the whole puzzle, when you look at all those pieces together, we have consistently been adding to storage since 2014, and that trend has not stabilized or reversed. If you look at the trajectory of that line, it's actually accelerated over the past couple months. So again, this is just another signal that we have not balanced the market, that we will have a price recovery at some point, but it's going to take a while to get there. It's going to take between 1 to 3 years. When we look at a tighter time frame, so that last chart was showing you all the way back to 1986. Everyone on this call will get a PDF version of these slides after the fact. Some of the things we have highlighted on this chart are previous periods in history where we had major price changes or macroeconomic events, different things that impacted the crude market. This view is tighter, so it's only 2014 forward. What you can see here is that same information. We continue to add to global stocks, and then you also see the U.S. component of that. So the U.S. piece is the blue line. So certainly adding to U.S. stocks has been a key piece of global stock additions, but it's not the whole story. And if you look at the last quarter, global stocks have actually increased at a rate that surpassed U.S. stock builds. So let's look at the U.S. in a little more detail. So this is current crude and product stocks versus TI spot prices. So this is just the U.S. If you look at U.S. crude stocks, we're about 100 million barrels above where we should be at this time of year. If you look at total stocks, excluding the SPR, that trend continues. We're significantly higher in storage than we should be. If you look at what's going on with TI, obviously this is really what led to the price collapse. If we were to extend those numbers forward, what we're basically saying is that once we really start to see a meaningful growth in demand and a flattening of production, then we have to work off storage stocks, and that's when you'll see prices recover. So again, it's not going to be a quick thing. If we look at our view of what crude storage will look like in the U.S. going forward through the end of this year, That's the chart to the right. So that's just showing you the levels of storage build and where we are today relative to where we should be. That dotted line, we don't anticipate that we'll fill storage, but again, it doesn't go away. We have to use those barrels before prices will recover long term. If you look at the chart on the left, that's supply. So that's crude production. U.S. supply has definitely flattened out. We're starting to decline a little bit month on month, but production overall in the U.S. has really been pretty resilient, more resilient than some people would have thought or hoped. That's also a key reason why we expect the recovery to take a while. We're going to talk a lot about the specific economics of U.S. crude production and how much growth we could expect at different key price thresholds. So the U.S., the market's gotten used to the idea that the U.S. has taken over as the marginal supplier of crude globally. We're not exporting much physical volume other than stabilized condensate, but every additional barrel that we grow, we are either pushing out an import or we're sending out as refined products. So if we're going to really understand what TI prices will look like into the future, what global crude prices will look like going forward, it's all about the marginal cost of production in the U.S. So because that's the world that we live in, we spend a lot of time understanding what those economics are. This chart is showing you WTI break-evens for those 300 areas across the country that we break out. These break-evens are half cycle. So they don't include acreage, they don't include exploration costs. They're half cycle break-evens. These are calculated at 275 gas. So what would crude have to be at 275 gas to get you a 20% rate of return over the life of the well? So that's another key assumption here. It's not a true break-even. It's assuming you have to get at least 20% rate of return. That 20% for us is indicative of a company break-even. So while you hear a lot of information in the news, a lot of things in the media about access to capital, about producer balance sheets, if producers can get 20% per well, there's capital available. If you can't, then obviously not as much. The drilling completion costs behind these numbers are also based on the 2Q 2015 financial calls. So in the coming weeks, we'll update them once we have the full picture of Q3, but these are as of 2Q. Now, some important takeaways about the chart. Each green column represents a break-even for a specific area. The labels on the bottom, they're impossible to read. We're going to look at the areas that are economic in more detail in a minute. You'll be able to see some of those names. But the takeaways here are there's a lot of areas that have break-evens below $50. Those are the areas where we still have rigs active, we're still drilling wells, we're still bringing wells online. There are also a lot of areas between the $50 and $70 mark. So the difference between 50 and 70 really is, are we growing production or not? And that's because of those areas that are in that range. Then you look above $70, there's also a lot of areas that have a break-even above 70. And a lot of those areas were being developed at a pretty low rate or low pace even before the price collapse. These are the areas that were offering the least returns even before prices dropped. So we don't expect a return to drilling in many of these areas, but that's okay because a lot of the areas that are economic produce the biggest wells and really supported growth and will support growth going forward. So we're going to look at our production forecast. So a couple things, a couple assumptions before we get there. Drilling activity is based on economics. So we're going to show you our base case forecast. We're going to show you how much additional production is out there at different prices that are higher than that. It's all about economics. So we're forecasting each of these areas. We're calculating a TI break-even. Based on our price forecast, if that area is in the money, we assume drilling goes forward. You see additional volumes. If it's out of the money, we assume it declines at a natural rate. So these are economics-based forecasts. NGL prices are a function of natural gas prices for ethane, and then for the C3 plus barrel, they're tied to Brent prices. Drilling completion costs are as reported in 2Q 2015 financials. And then one of the other key components here is our spud to production lag. So we are assuming 3 to 6 months between when a well is drilled and when it comes online. That's a very key difference between what we do and what the DPR, the EIA does in their DPR. They're assuming a flat 2-month spud to production lag. So what that means is if that lag is actually longer, you're going to see to see the impact of changing rig counts in their numbers before it actually materializes. We use 3 to 6 months because that's what we've actually observed in the data. We track rigs, we track rig activity at the well level. We also use well level production data. We can tell when a well was finished versus when a well actually shows up on production. So those real observed lags are what we're using. So if we look at economics, we look at what areas are driving production. So the green, those are areas that are economic below $52. The other part of this slide that's important is our price forecast. And again, our production forecasts I'm going to show you are based on economics and these price forecasts. Henry Hub, we expect next year to be 286 on average, 2017 325, 2018 350, and then growing to 403 by 2020. On the crude side, WTI, we expect $52 average prices next year, $56 in 2017, and $67 in 2018 through 2020. That 67 is what we believe is the long-term equilibrium price based on economics today. So $67 gets you additional growth, incremental growth of at least 500,000 barrels per year, year on year. It doesn't quite get you 1 or 1.5 like we were growing before the price collapse, but it gets you meaningful growth. So areas that are economic below $52. Those are the best areas. Those are tier 1 areas pretty much across the country. So you see the Eagle Ford, Hawkville, tier 1, near the top of the stack. You see the Eagle Ford DeWitt, tier 1. You see Permian, Central Basin Platform, tier 1. Ardmore, Appalachian PA South is even a tier 1 acreage is at the top end. Bakken, Threshold, Bakken Antelope, even Fort Worth, tier 1. So the best areas across the country are economic below $52. Between 52 and 56, areas like the Eagle Ford, the other Texas Gulf Coast comes in the money. The Eagle Ford, Eagleville, tier 2 comes in the money. Bakken, Nesson, tier 1 comes in. Threshold comes in. And then Powder River, Turner Formation comes in. Between 56 and 67, you get areas like the Briscoe Ranch in the Eagle Ford, the Bailey Field in the Bakken, Powder River Sussex Formation, and some of the Utica lean condensate window tiers. So there are areas all across the country that are economic. There are also areas all across the country that will become economic again as prices start to come up. Now this chart is generally the same information, but this is showing you those areas that are economic at a TI price below 70 if we run it at 350 gas. We also ran it at 275 gas and $2 gas. So what we're trying to show you here is there are some areas of the country, obviously, that are more dependent on gas prices. Those areas, right in the middle, that Eagle Ford, Hawkville. At $2 gas, you need close to a $50 TI price to break even. But if gas prices bump up to 350, you only need really a $20 TI price to break even. So this is another component that we watch, that we track very closely. What does changes in gas prices really do to the oil economics of a well, or the overall economics of drilling? Some of those areas, the areas you see with more green and red, those are the areas across the board that are going to be more sensitive to gas prices. So our production forecast. This is crude oil, so this is actually crude and condensate. So this is production that's a liquid at the wellhead. The colored areas are our forecast broken out by quality. So you can see we're hovering really right around 9.5 million barrels. We do see some slight declines between now and really 2016, 2017. After 2018, we really start growing again. Growing again about 400,000 to 500,000 barrels incremental year on year. That growth, and again, these are tied to our price forecast and economics. So that growth after 2018 is all about our view that crude prices will recover to $67 and support drilling in some of those areas. The blue and the green on the bottom, those are heavy barrels. So that's 0 to 25 and then 25 to 35. That is pretty much flat. So the question from here on out is how much will light production grow? How much will 35 to 42 grow, which has a lot of Bakken in it? How much will 42 to 50 grow, and 50 plus? A lot of that is Eagle Ford, and even some of the lighter wells that are coming out of the Permian. So we expect production by 2020 to average 11.2 million barrels. and that's a 2020 number. So between now and then, we do expect it to remain pretty flat, but we do think it will remain pretty resilient. You're not going to see huge declines. You're also not going to see increases until we see some price recovery. The black line, that's the potential crude that's out there. If we had kept drilling, like we were drilling before the price collapsed, before the rig count fell in half, if we had kept drilling at that 2014 rate, then you would have the black line. You'd have us approaching really 16 million barrels by 2020. Now that obviously isn't happening now. We're drilling at a much lower rate, and actual production looks something like the colored areas. Now the capacity lines, the dotted lines you see on here, we're going to talk about those a little more later, but those are the important pieces of the rest of the crude story, of export question. Why do we need to export? What's our actual capacity in U.S. refineries to take domestic crude? And we'll talk about that more in a couple slides. Okay, whoops. Okay, so if you don't believe our price forecast, if you want to see what crude is out there at different prices, that's what these charts are intended to show you. So the gray area on the bottom of both of these charts, that's a natural decline. That's what happens if we quit drilling any new wells starting today, this month. The top chart is showing you crude. The bottom chart is showing you gas, and it's actually dry gas. If each of those colored wedges represents a price band. So the gray is what happens even if we don't drill any new wells. The red, that's additional volume that comes from areas with break-evens in the 10 to 20 range. So those are the most economic areas in the country. A lot of that is coming from the Marcellus or the Utica. The green is 20 to 29, so that's incremental volumes you get from 30 and below TI prices. 30 to 39 is the blue. The gold one is pretty important. So we have that one highlighted. We have an arrow to it. That's what production you could expect at a TI price of $50. And this, again, is run at 275 gas. So what you can really see here is that $50 gets you pretty flat to slight increases. Anything above that, you're growing production again. Anything below that, and you're declining pretty significantly. The other takeaway here is that yellow band is wider on the gas side. So gas production is absolutely being impacted by lower crude-directed drilling. And we're going to talk about that in the gas section. But we're not getting as much associated gas because we're not drilling as much for crude. The gas markets in general are getting a little more interesting because we are poised to have significant structural gas demand come online. So the fact that that yellow band is thicker for gas than it is for crude, that's meaningful because that means that 275 gas is probably not the right answer, and not the right answer really depending on weather, certainly starting in 2017. But by the time you get to 2020, we need a higher gas price to support the structural gas demand that we have coming online. A couple key points about exports. So the U.S., we currently export nearly 3 million barrels a day of refined products. So even though we're not exporting crude in any meaningful volume, we are absolutely an active part of the global market for products. Before the U.S. production levels hit 12.5 to 13 million, exports are important because of quality issues. So again, our refining fleet is not necessarily tooled to take light crude efficiently. They can do it, and we're going to talk about that. Can they even take it? And the answer is yes, they can take it. But you don't make as much of the high-value products when you take lighter barrels. You get more gasoline. So if that's what's happening, it means U.S. refiners are not going to be willing to pay as much for those light barrels. If we could export, we would send those barrels abroad. We'd bring in heavy barrels. Our refiners would maximize their netbacks. Our producers would get the best price for their barrel. And that's between now and 12.5, 13 million barrels of production. After we hit that 12.5 to 13, it becomes necessary. We cannot grow production past that if we don't have some kind of outlet, because we will run out of physical capacity to put it into our domestic refineries. Longer-term U.S. production growth and global crude prices will depend on both the ability to export and then global demand for refined products. So this is something that we already saw play out on the gas side and even on the NGL side. We can bring a lot of production on at relatively low prices. The question from here on out is how quickly will demand grow to take it on the other side of the pipe, on the other side of the ship, whatever it looks like. We are only constrained in terms of production by the ability for demand to soak it up. All right, so let's jump into some of these data slides. The U.S. is currently exporting about 3 million barrels a day of finished petroleum products. The biggest component we export is diesel. Diesel, almost 1 million barrels a day of exports. Gasoline, 300,000 to 500,000 barrels a day. Coke, about 500,000 barrels a day. Fuel oil, up to 300,000 barrels a day. And then other products right there in the middle in green, and then kerosene in blue. So we are already an active part of the U.S. export market. If you look at why do we need to export? What's going on with crude production? We haven't produced up to 13 million barrels a day yet, so what does that really mean? Well, if you look at type of production we're growing in the U.S., it's light. But if you look at trends, the demand trends are exactly the opposite. So gasoline, you get a lot of gasoline from light barrels, but gasoline demand in the U.S. is declining. Diesel demand is on the rise, but you don't get as much diesel from light barrels. So what this really means is that our refiners are facing this conundrum. They've got lighter barrels showing up that don't make as much of the products, that have the best prices, and whose demand is actually growing. Let's talk some more about those refineries. So this is the same chart that I showed you for production, but now we're going to focus on those demand lines. Nameplate U.S. refining capacity is about 18 million barrels a day. If you assume we can only run at about 90% long-term utilization, that's about 16.5 million barrels. Then you subtract from that structural imports. So there's about 3 million barrels a day that comes in from Canada. We need those heavy Canadian barrels to blend with our light barrels to make the slate of refined products that we demand. You also have about 1 million barrel a day of structural imports that come from Venezuela or Mexico or Saudi Arabia. And a lot of those barrels are coming in to refineries that are owned by those PDVSA, Pemex, Saudi Aramco, Petrobras. So those are what we call sticky imports. You can push them out for the right economics. Those refiners would choose to source a cheaper domestic crude, but they're sticky. They're harder to push out than just a traditional import that's selling on the market. What that really means is you take that 16.5, you subtract 1 million of structural, you subtract another 3 million of Canadian imports, you really only have about 12.5 million barrels a day of refining capacity to take domestic crude. But even until then, even until we hit that ceiling, if you look at what we import in this country, so this is showing you imports by country. The ones that are in that gray box, those are predominantly heavy crudes coming from Canada, Mexico, Venezuela, Saudi Arabia, Colombia, and Ecuador. You look at that between 6 and 7 million barrels, that's the mid-range barrels, mid to light. We've already pushed out most of our lightest barrels. We don't really have much mid-range to push out. From here on out, if you believe our production forecast, as we continue to grow crude production, we're going to have to push out additional imports. And once we get to about 2017, we're really going to have to start pushing back on heavy imports. So what does that mean? It means that we have to look at the economics for refineries. If refineries can't take as much heavy, how much are they going to be willing to pay for the light? And that really depends on the refinery. So this is Valero's Corpus Christi Bill Grahey complex. This is a 200,000 barrel a day complex. In this first example, if we put 66,000 barrels a day of 20 API heavy, maybe it's a Mexican Mayan, 66,000 barrels a day of 40 API Eagle Ford crude, and 66,000 barrels a day of 60 API Eagle Ford condensate. You put that through this refinery, you get 2,000 barrels a day of LPG, 81,000 barrels a day of gasoline, 40,000 barrels a day of distillates, 67,000 barrels a day of heavy gas oil. The gate value of those products is about $9.5 million. The cost of crude is about $9.1. This refinery is netting about $420,000 a day of profit. Now the second scenario, let's kick out the mid-range barrel. Let's kick out those barrels. Let's just do half and half. Half heavy, half light. In this example, you get more gasoline, 8,000 barrels more. You get 14,000 barrels less of distillates. And again, distillates is where your value is. And you get a little bit more heavy gas oil. The gate value of products has gone down because you're not making as much of those distillates. It's only 8.9. Your cost of crude has gone down because heavy barrels are typically discounted. In this example, this refinery is breaking even. Now to make them whole, to bring them back up to that 420,000 a day mark, this refinery would demand a discount for those condensate barrels of $4.30. Now that $4.30 depends. If you're at Marathon's Canton refinery, they just installed a topping unit, they're better suited to take light barrels, that discount might not be as high. If you try and do this in Louisiana, at Baton Rouge, they're better suited to take a heavy barrel, that discount might be as high as $10 or $12. What this is also illustrating is that light barrels are inherently less valuable because they don't make as much of the high value products. So as we push out those heavy imports and we try and shove in our light domestic barrels, there's going to be a price impact. You're going to see that refiners don't value those light barrels as much, and you're going to see discounts for condensate streams and even ultralight crude streams. The other question is, can our refineries even take these light barrels? So that's one of the questions you hear a lot. They're not well suited to take lights, but can they do it? And the answer is yes. So this is Gulf Coast refineries. The colored areas represent the capacity at those refineries to take different streams of crude. So the yellow is 50 plus, the 0 to 25 on the bottom is that blue one. Overall, that's the bar you can see on the far left. Overall, the refineries are complex. They do like a heavier barrel, but there's still a lot of capacity that they can take and handle a light barrel. So it's not necessarily a question of can they take it, it's what price discount will they demand because the products aren't as valuable. All right, so we're going to shift gears. We're going to talk about natural gas. So we mentioned briefly that natural gas production volumes are absolutely being impacted by less crude-directed drilling. This is storage, but really, if you look at 2015 to date, Ponderosa was forecasting natural gas prices would average $2.69, and we're a penny or two off. Prices at Henry Hub averaged $2.99 in January and have moved lower pretty much since then, dropping to below $2 in late October. And really, this is all about supply demand and specifically storage. If you look at storage, we hit record levels last week. We're probably going to inject for a couple more weeks and continue to adjust that record upwards. If you look at what's going to happen this winter, so inventories, they're likely to reach very near the 4 TCF level. That means that depending on what happens with winter, we could easily exit the winter season at very high storage levels, similar to what we saw back in 2012. So what does that mean? It means we're only sitting at, what, 225, 229 for December right now. If winter doesn't show up, we could very easily set new low records in the spring. So that's certainly something we have to watch out for. We track weather very closely. It certainly seems like this El Nino event could materialize. What that means is relatively mild winter, weak demand, we come out of storage very high, we have very low spring prices, and they stay low throughout the summer to incentivize some coal to gas switching, some additional demand so that we don't blow past storage. If we look at our dry production forecast, so again, when we forecast production, we forecast the whole well. So the crude forecast I showed you, they go with this dry gas forecast. What you can see on the dry gas side is the colored areas here are broken out by region. So the rest of the U.S. is blue on the bottom. Permian we broke out, Eagle Ford we broke out, and then of course Marcellus Utica. Marcellus Utica will lead the production growth in terms of outright volume, but on percentage terms, we expect Eagle Ford to grow the most. So 26% growth in the Marcellus Utica, 41% in the Eagle Ford, 36% in the Permian, and then the rest of the U.S. to decline at about a 10% rate. And that, again, those numbers are between 2015 and 2020 average yearly prices. Now, in terms of the trajectory of this line, it's pretty flat. It's not growing anywhere near the rates that we've been growing for the past few years. So what does that mean when you think about all the structural demand that's going to come on in the next few years? Now, this is the same numbers, but it's average yearly. And we added the import bar on there. We've also added demand. So we track gas demand very closely. We're looking at the 5 LNG terminals that are under construction. We're looking at how much capacity that will add. We're looking at global LNG prices and the ability for us to export LNG. We're looking at power and the structural growth that's happening from new gas-fired power generation and retirement of old coal facilities. We're looking on the power side at competing feedstock prices and how gas is competing with even sources like nuclear generation now. On the U.S. demand side, we're also looking at industrials, so new facilities that are being built, whether it's a steel plant or a car manufacturing plant or a DTL facility or a methanol plant. All of those things are going into that black demand line. And what you can see here is that at 275 gas, there's very likely going to be a shortfall. If U.S. demand grows, like we believe that it will, you're looking at a shortfall of production. Now, there's plenty of gas out there. So the question is, how high do prices have to come up to fill that shortfall? And that really is the basis of our natural gas price forecast. That's why we are forecasting a $4.03 price out in 2020. That's the price necessary to fill that gap. So if we look at that gap, so this is that same gap that we just looked at. This is that price forecast. That gap's about 14, almost 15 BCF a day. Where would it come from? So we have some pretty major gas producing areas that are not in the money today, but will come back in the money at prices significantly below $5. So we don't need to have $5 to see upwards of 20 BCF of additional production. And that's why our price forecast is $4. We don't quite need to have 5, but we do need prices above 275 or 225 that we're currently at, or we're not going to be able to fill that gap. The gas areas that we expect will fill that are the northeast part of Pennsylvania. That area has a break-even between $2.20 and $3.90, depending on which tier. So tier 1's $2.20 break-even, tier 3 is $3.90. Now that's without a basis adjustment. So if you look at current prices, you subtract current basis, they're $1.50 back. So certainly they're out of the money today, but as pipelines come online, we bump up some of that outbound capacity to take some of that gas away. Some of these areas in northeast PA will come back in the money. You also have the Haynesville. So Haynesville, at its peak, we were running close to 150 rigs. We're not running anywhere near that today. But those break-evens come back in the money between 275 and 410. And then Fayetteville. Fayetteville, if we need Fayetteville, those break-evens come in between 350 and 525. So what is the risk to that demand line? And what does that mean for the short term? So in the short term, you look at that demand line, we know there's 5 LNG export terminals under construction. Lower crude prices certainly shrink the arbitrage opportunity that used to exist to send LNG abroad and to land those barrels and compete with other countries for LNG. And it's also power demand. So we look at power, and let's look at it just in the very short term. If 2016 is going to look a little bit like 2012, in that we exit the season at very high storage levels, gas prices drop to incentivize demand, how low do gas prices have to drop before you would see meaningful coal to gas switching? And how low could they even drop this winter if we don't see winter temperatures show up to even incentivize some coal to gas switching over the winter? So this top chart on the left, this is showing you the cost of electricity generation for gas and for coal. The red is coal, the green is gas. You can see in 2012, gas had to dip below coal to push some of that coal out. We saw switching of about 5.5 BCF per day that summer. If you look forward to this year, well, commodity prices as a whole have come down. So coal is cheaper now than it was back then. So if we're going to push out coal, we're going to have to do it at a lower gas price. What does that mean? It means $2.25 is probably not enough. You're going to have to see a gas price in the $1.75 to $2 range to knock out any significant coal generation and push gas up in the stack. If you look at power capacity additions on the gas side, in general, and this is longer term, we are growing, and power generation for natural gas is going to grow. We have new facilities coming online. Coal across the board is really losing the battle there, and gas will continue to take a bigger part of that market share. You see 2016, even next year, second quarter, we have over a BCF a day of additional power capacity coming online. So there is structural gas demand on the horizon. The bad news in the shorter term is that all commodity prices are depressed, and if we're going to switch to any meaningful degree this winter or next summer, we're going to have to do it at a price below $2.25. Other shorter term dynamics, certainly prices. If we exit the season at record levels, we're not going to have probably $2.25 in the fall, or in the spring, it's going to be lower than that. Certainly El Nino, it seems like that's going to materialize. Everybody in the market, or generally the market is expecting that that will happen. That generally means warmer than normal temperatures to most of the lower 48, specifically where demand is. So we're not going to have strong demand. It might look very much like the winter of 11-12. On the storage side, if we're going to hit over 4 TCF, it means if we are still at high levels in the spring, it's probably higher than the levels we saw in 2012. So keep an eye out for that. All right, so that's gas. So in the shorter term, certainly looks like some price pressure. Longer term, $2.75 is not the right answer once we have some of the structural gas demand facilities come online. NGLs. So let's talk about NGLs. And we're going to finish up in about 3 minutes, and then we'll have some time for questions. So NGL prices continue to fall. There's no surprise here. Propane prices dipped as low as 35 cents earlier this year. They've rebounded since then, but across the board, NGL prices are depressed. Some of this is because of crude price pressure. Some of it's because we are supply long. We have more volumes than we really have demand to take them on the other side. And we don't expect that to change much. So we believe that ethane, we'll talk about our price forecast in a minute, but we expect to continue to see price pressure on the NGL side. There's also an implication there for natural gas. So if NGL prices stay pretty low, it means drilling wet wells, there's not as much uplift there as there used to be. So we're seeing this trend in the Northeast where they're pushing, producers are deciding to drill more drier gas wells because the additional size you get on the gas wells, the dry gas wells, makes up for the uplift that you used to see because of the NGL production. So that's across the board happening. It means that GPMs in the Northeast, they won't be increasing at the rate they have been. We expect that to level off. Doesn't mean we're going to run out of NGLs though. We've got a lot more slated to come online. This is NGL production. This again is tied to those same gas forecasts and same crude forecasts that I showed you. This is broken out by pad. So pad 3, going to lead the charge in terms of growth. That's the Eagle Ford, it's the Permian. Pad 2, you've got some growth towards the end or the later part of the decade. You've got pad 1 in green, pad 4 yellow, pretty flat to declining a little bit, and then of course pad 5 kind of squeezed there in the middle. We expect, if production today looks like about 3.3 million barrels, to grow over 4 million barrels by 2020. So even though NGL prices are depressed, even though we're not drilling as much for wetter gas in general, we're still growing NGL production, and we're still going to grow significant volumes. For ethane, so what does that mean? We're still going to grow production. Ethane is certainly the biggest component of that. Current ethane, we model and we believe that we're currently rejecting about 40% of ethane in the U.S. That 40% rejection rate means we could recover that. If prices supported it, if ethane bumped up to 27, 28 cents, could cover the fractionation and the transport cost, you would see additional ethane recovered. Once crackers start coming online, and so this is the chart on the left, that black line is showing you ethane demand. The bumps in that line are world-scale crackers that are slated to come online between now and 2020. So we are going to recover more ethane, significantly more starting in 2017, but you still see more ethane than we need. So we're still going to be rejecting some volumes. We're just not going to be rejecting as much. On the price side, so ethane prices, we expect them to stay at parity with natural gas. If they're 17, 18 cents today, we do expect that they'll increase over time as our gas prices increase, but we expect they'll stay tied pretty closely to Henry Hub. C3+, so propane, we have increasing butane, natural gasoline, ISO, all of those are increasing. We don't expect them to return to their historical linkages to crude, but as our crude price forecast increases, you also see those NGL prices increase. So nothing really game-changing here, but on the NGL side, we really expect it to be more of the same. You're seeing pressure on all sides. Natural gasoline is seeing pressure because oil sand production and projects are getting pushed. Butane is used primarily to blend in gasoline. Well, we're producing a lot of condensate, a lot of light barrels that also make a lot of gasoline. And we don't really need that much gasoline because demand for gasoline is declining and we're exporting more and more volumes. So butane, we do expect to continue to get squeezed, as well as propane. All right, so that's the core of our material. These are some of the cover pages of the Market Outlook report. So the Challenge of Abundance was our first big yearly report that we released in the spring. We are releasing our next big report in November. The Over a Barrel and Market Malaise, those are our interim updates. So with a subscription service, we basically release 2 big reports yearly, and then we release interim updates every 6 to 8 weeks, depending on what's going on in the market. The next big report, we're going to focus on, again, the current dynamics driving oil, natural gas, and NGLs, how our production forecasts have changed, what's going on with underlying economics, and how they've changed. We're also going to look in more detail at U.S. demand for natural gas. So what's happening with LNG export terminals, and how full do we expect those to run once they come online. We're also going to look at other U.S. infrastructure projects for crude, natural gas, and NGLs. So there are pipelines that have been canceled. There are other pipelines that are getting pushed out. We're going to look at where will we need additional infrastructure, where are we overbuilding infrastructure. We're also going to look at hedging and guidance for top 20 U.S. producers. So what does that mean for prices next year? How well hedged are producers, and what does that mean in terms of their decisions to drill wells or not, given our view of what cash prices will look like. And then, of course, we're going to update for the most recent round of producer borrowing-based determinations. So that's, everyone's talking about access to capital right now. We're tracking it very closely. We're going to look at what the fall season really meant for producers and how that may impact their CapEx and their budget decisions going into next year. All right, so that's the material. I do have some questions for you. All right, so we've got, and again, if anyone has questions, please send those in to the info@ponderosa-advisors.com email account. Okay, so the first question, will the rejection of Keystone XL pipeline have any impact on U.S. oil prices or refinery operations? So the short answer to that is we don't think so. The reason we don't think so is we have that big refining model where we look at every refinery in North America. We look at all the existing transportation options to get you there. We can see bottlenecks. We can see where additional pipe makes sense. We can see where pipe's overbuilt. We can see what crude our refineries will demand as domestic production grows and as we start pushing on imports. The whole time the market was, and really the government was debating Keystone XL, Enbridge essentially built the same system. So we can move a lot of Canadian production down to the U.S. We can also move incremental barrels by rail. The Edmonton facility, I think they have the 5th crew under training right now. That'll move some more product down to the Gulf Coast. So the short answer is oil sand production growth is flattening. We keep seeing those projects get pushed, and we expect that to continue to happen because they're not economic unless you have a WCS price of about $55. So we expect that will happen. We don't think you need Keystone XL, but for Canada, for them to be able to grow in the future as prices recover, they will need an outlet. So we think that Energy East makes a lot of sense. When we run our model with Energy East, we see it pretty much filling up. There's a lot of international demand that could take those barrels. India, for instance, really likes a 26 API barrel. So we don't necessarily need more of that production in the U.S., but Canada will need an outlet to get those barrels out if they continue to produce. Next question. So will the economics of natural gas in the Marcellus and Utica continue to drive investment there regardless of crude oil prices? And the answer there is yes. You look at Marcellus, even some windows in the Utica, those are the most economic wells to drill in the country. We're seeing wells continue over and over, 20,000 a day wells come out on the gas side. Those wells are at the top of the stack. That drilling and that production will continue. You can also see it in the rig count. So we've lost over half the rig count in the country. Marcellus has only lost 30%, where everywhere else has pretty much lost 50 to 60, even 80% in some parts. So rigs have been more resilient in the Marcellus, and it's because of the economics. They're at the top of the stack, and that will continue. So that's where we will see production continue to grow on the gas side. The question will just be how quickly and can that additional production volume outpace the declines we're seeing in other parts of the country on the gas side because of lower crude-directed drilling. And again, that goes back to our view of dry gas production. We don't think that 275 is the right answer long term because we would not have enough gas to meet that structural demand that's coming on. So we have another question. It's how much impact will LNG exports have on reviving production in the Haynesville and Fayetteville? So we looked at the Haynesville and Fayetteville. Certainly those are areas that are close to the market. The hard part with LNG exports, and if I had to risk our demand line for gas, that's the risk. It's LNG exports. If you just look at the 5 facilities that are under construction today, and if we only ramp them up to 75% utilization, that's over 7 BCF. The total global LNG import market was 32.1 BCF in 2014. So we're trying to land significant volumes into a market that's really not that big. That call it 8 BCF of capacity. That's almost 25% of that global LNG market. So I don't think we can assume that we can shove 25% more volume on the market and not impact prices. So we do think that it's more likely that U.S. LNG exports will pull all prices down, not bring U.S. prices up to international price levels. But that being said, some of those facilities will come online. Some of them will run. Definitely, we're going to send LNG out. I just don't think we can assume that we max out those facilities and that we are selling into an infinite demand sink. For the Fayetteville and the Haynesville, they do have very low economics. They are some of the most economic dry gas plays in the country, aside from the northeast part of Pennsylvania. So as gas prices tick up, there will be tiers, Tier 1 and Tier 2, in both of those plays that do come back in the money. Okay, our next question. So natural gas is at $2.30 right now. Do we think the $2.86 is too high for 2016? And I would say definitely. If you're looking at gas prices, you're looking at storage levels, you're looking at likely weather scenarios for the winter, if we exit the season, the storage season like we did in 2012, you're not going to see $2.86 prices next year. You won't be able to. If you don't have significantly lower prices than $2.86, you're not going to see coal to gas switching in any meaningful way. We would blow past storage. And we know that that never happens. The market works, especially on the gas side. Prices will be as low as they need to be to incentivize that demand so we don't end up shutting in production or blowing past storage. But that definitely means if winter fails to show up this year, it's going to be at a price below $2.25 next year. Along the same lines, are we going to see a one handle on gas in the spring? I think it's pretty likely, given what we're seeing with weather right now. But again, it's weather. If weather shows up normal, then no. We can have $2 to $3 prices again next year. If it doesn't, definitely one handle makes sense. And then, so we have time for one last question, so we'll talk about the one about switching. So what natural gas price do we need to encourage coal to gas switching? So we have an economic dispatch model we use on the power side. So we look at all the facilities that are online, we look at their economic dispatch. Given current coal prices, we would need a price between $1.75 and $2 to push coal out of the stack and to fill it with gas. So it's $1.75 to $2. If coal prices come down, it's lower than that. If for some reason coal prices come up, then it would be a little bit higher than that. But it's $1.75 to $2. Okay, I think that's all the time we have. I think that's all the questions we have time for. Everyone will be receiving a PDF version of the slide deck following the call. Please feel free to reach out to any of these contacts you see listed on the screen if you have additional questions, or email the Energy Group at ponderosa-advisors.com and we can get back to you. Thank you for your time. We'll talk to you soon.
This ends the Ponderosa Energy webinar.